We're diving straight into an analysis report on Nebius Group fundamentals. It argues pretty forcefully that the current $87 stock price is a major undervaluation.
A very strong bull case. Puts the analyst target at 164. So what, an 88% implied upside?
And what really makes this compelling right from the start is the clarity. There's no hedging. It just hits you with these huge numbers. 355% revenue growth, $4.8 billion in cash.
Don't forget the big contracts, the Meta and Microsoft deals.
Right. So this isn't just an analysis. It's a real statement of conviction.
Absolutely. And that conviction is the strength here. The core thesis that the stock is cheap is solid. So, we're not here to question the fundamentals.
We're here to strengthen the argument.
Exactly. To critique the structural defense of those fundamentals. Make sure the thesis is, bulletproof against the kind of noise the market always throws at these hypergrowth companies.
Okay, so let's start with the biggest piece of that noise, what the report calls the contagion discount.
Yeah, let's. The analysis needs to more aggressively neutralize the systemic sector risks that are implied in that section. It has to make the bull case structurally immune to broader market fears.
It does a pretty good job identifying the immediate trigger, right? The almost 7% drop after Oracle's earnings miss.
It does. It calls it sympathy selling, the classic baby out with the bathwater scenario.
And that's a good diagnosis of the event itself, but I'm not sure it really gets to the root of the market's fear.
It doesn't. And that's the weakness. Just putting a label on it, sympathy selling, it doesn't actually dismantle the market's logic.
What is that deeper logic then?
The risk the market is pricing in isn't really about Oracle specifically. It's the fear that, okay, if a giant software vendor like Oracle is seeing a slowdown,
then maybe the whole corporate IT budget pool is tightening up.
Exactly. And that eventually that slowdown hits everyone, including NBIS. So the market is asking, is this an early warning sign for the whole sector?
And if the analysis doesn't get in front of that fear, that risk premium just stays baked into the stock price, no matter how good the fundamentals are.
Precisely. So the suggestion is to reframe that fear, the fear of slowing corporate IT spend, and then use the report's own evidence to just completely refute it.
Turn their fear into a strength for the bull case.
Yes. You have to explicitly show why NBIS is structurally different from a company like Oracle.
Okay, so how do we make that comparison concrete? How do we make it undeniable?
You weaponize the whale validator section. We're comparing apples to, digital elephants here. Oracle's revenue is tied to enterprise OpEx.
Operational expenditure.
Software licenses, subscriptions.
The marginal IT spend that's the first thing to get cut when CFOs get nervous. Nebius, though, they're selling access to massive, long-term AI infrastructure.
So we link that $3 billion Meta commitment over 5 years and the Microsoft leasing deals, we link that directly to CapEx, capital expenditure.
Exactly. The report has to hammer this point. NBIS's revenue is tied to the huge, multi-year CapEx budgets of hyperscalers. This is not some variable OpEx that you can turn off and on.
Right. When Meta commits $3 billion, that creates revenue visibility for years. It completely isolates Nebius from the kind of quarter-to-quarter panic that hits other companies. You don't just pause a multi-billion-dollar AI build-out because some other company missed its quarterly numbers.
That's the crucial distinction. So the analysis should show how those long-term contracts make Nebius immune to that specific contagion narrative.
It shifts the risk. It's no longer about enterprise budget softness. It becomes about hyperscaler CapEx cancellation, which is a much, much higher bar.
It's about building a narrative fortress.
A narrative fortress, I like that. When the market sells off on these broad IT fears, the report should be the shield that says, your fear is about variable OpEx, our revenue is powered by fixed CapEx. The two aren't the same.
That really elevates the whole analysis. Okay, that handles the external threat. Let's move inside the balance sheet. The report highlights the $4.8 billion in cash, calling it the fortress balance sheet.
Right. And on that point, the material should transition that $4.8 billion cash pile from being a static fortress balance sheet into an active competitive operational moat that justifies continued investment in an unprofitable growth company.
I noticed that. The report kind of presents the cash and the need for massive CapEx, buying up all the NVIDIA H100s or Blackwell chips, as two separate good things. Cash is good, chips are necessary.
So NBIS is well positioned. But what's missing in that connection?
Exactly. What's the missing link?
The power of that cash. It doesn't show how it actively fuels that 355% growth rate. Skeptics see an unprofitable, high-growth company, and they immediately price in dilution risk.
Future capital raises that'll devalue their shares.
Right. The report frames the cash as a safety net. The market needs to see it as the engine.
Because that incredible growth rate also means an incredible cash burn. to buy the assets to support it.
And the cash has to be the active solution to that burn. So the suggestion is to directly link the cash to the operational risks of hypergrowth. Show, even if it's just conceptually, how that cash insulates them from having to go to, volatile, high-rate debt markets right now.
That immediacy is the key.
It is. When NVIDIA opens up orders for the next-gen chips, the winners are the companies that can write a multi-billion-dollar check on the spot without waiting for financing.
So it's not a passive shield, it's an offensive weapon, an acceleration button.
Think about it this way. Management says they are sold out of capacity. If they can't deploy new CapEx, and fast, then growth just stops, dead in its tracks.
So the $4.8 billion is the direct enabler of Phase 2.
Yes, it makes their execution dependent on cash availability today, not slow, expensive credit market access tomorrow. It basically turns that cash into a strategic weapon to corner the market on future supply.
The analysis does bring up the enterprise value calculation. Market cap of $22 billion minus the $5 billion in cash gives you a $17 billion EV.
And that is the perfect place to land this point. The analysis should use that EV calculation to argue the market isn't just discounting the stock, it's implicitly underappreciating the strategic value of that cash.
So when the market values the operating assets at $17 billion,
it's failing to see that the $5 billion in cash is being actively deployed to secure, say, $10 billion in future revenue. You have to shift the perception of cash from a dead asset on the balance sheet to a dynamic, yield-producing weapon.
That totally changes the argument. It's not about where they are, it's about what they can do because of where they are. Which leads us to the growth narrative itself and that sold-out comment.
Yes. Given management's confirmation that they are sold out of capacity, the analysis should strategically shift the focus from proving market demand to proving management's exceptional capital allocation and execution speed.
This feels like a really critical pivot. The hypergrowth mode section, it's all about that incredible 355% year-over-year growth. That's the proof of concept.
It is. But the moment management says the bottleneck is plugging in GPUs fast enough, the entire story changes. The bottleneck is now supply, not sales.
And that's the weakness in how the report is looking forward. Highlighting past growth is great, but it risks being backward-looking if it keeps talking about customer demand.
Right. If supply is the constraint, future growth depends entirely on internal execution. By still focusing on demand, the material is actually underselling the complexity and the real investment thesis here, which is the operational challenge ahead.
So we need to draw a clear line in the sand. This is a new phase for the company. What does that shift mean for an investor?
It means the story is no longer a sales story. It's an operational and a CapEx deployment story. The report needs to reflect that pivot. It should set new expectations, define the new KPIs that matter.
I like that framing. It's moving from the proving grounds to the building phase.
And the analysis has already established they solved the hardest part, right? Commercial validation from Meta and Microsoft. So how do we communicate that the key metric now isn't just another big revenue number?
It's about efficiency, the speed of CapEx deployment.
Exactly. You use the numbers you already have, but differently. Frame that 355% growth rate as the undeniable proof of their past operational scaling. It proves they can deploy assets at incredible speed.
And then you pivot to show how the $4.8 billion in cash enables that exact same level of speed for the next wave of NVIDIA chips.
Now you're changing the valuation question. The $87 price tag implies the market hasn't fully grasped the certainty of the demand or their capacity to execute on it.
The real bull chase then isn't just they're growing fast.
No, it's that they have solved the two hardest problems in this sector at the same time. They secured multi-year, multi-billion-dollar demand, and they secured the capital to meet that demand instantly.
That makes them an operational outlier.
And the analysis needs to state that explicitly. The only real variable left is execution speed. And given their track record, that risk is priced way too low at $87.
This has been a really focused critique.